Good morning, everybody. Hey, welcome to this Wednesday, the 3rd of April. Hope everybody's doing well today, halfway through this first week of April. And yesterday, well, markets not liking it at all. A disastrous day yesterday on Wall Street. We'll talk about that and more when we join Dave here in just a few seconds. But remember, it's days like this that we want to make sure that the risk we have in our portfolio truly matches up with the amount of risk we should have in our portfolio. That's why I developed the core retirement design. Give us a call at 863-382-0037 to schedule your core retirement design. With that, we've got Dave coming up next.
Play there from 105.7 Light FM. Hi there. It's 8:42, 18 here before 9. That's about, call it about 48 minutes before they start throwing real money around on Wall Street. And so far, based upon the last 2 days, they're basically throwing it in the trash. Not a good day on Wall Street yesterday. Let's try to sort the whole mess out with Phillip Statler from Statler Financial Services in downtown Sebring. Phillip, good morning. It's sunny outside. I wish it'd kind of get some sunshine on Wall Street. Wouldn't you agree?
Yeah, it is one of those time periods right now, Dave, where we're seeing red ink to start the quarter off. And yeah, maybe, just maybe as we get some more earnings, if we get some good news, maybe it'll turn around. But for right now, we're looking at a third day of some red ink.
Oh, yeah. Yesterday was just poopy. There's just no way about it. I mean, I look at the charts for the major indexes, and they were just down, and they stayed down, and they never recovered, and there really wasn't much movement yesterday. The Dow was down another 396 points yesterday. They were hacked off. That's a full 1% on the Dow. Standard & Poor's was down by 38. The NASDAQ was down almost a full percent, down 156. I mean, if it wasn't nailed down, we were selling it, and the only thing going up is oil futures. And when we get to that, everybody's going to have a bad day, aren't they?
Yeah, and then you had the Russell 2000, man. It was down 1.8% yesterday. So it was just not a good day, Dave.
That would be a nice understated way to put it. We start the morning out with more indications that are going to give sellers reason to sell because, boy, the economy sure is looking nice. The ADP report, it's employment week, and we get all this data that if it was a little mediocre, it'd probably put a little cheer on Wall Street. But we hired more people in the private sector last month, according to ADP, than we have for the last 8 months. 184,000 new private sector jobs last month. If we weren't hoping for an indication of a slight slowdown, that'd be great news for the economy. Mortgage applications did fall into the 0.6%, which, given what mortgage rates are like, probably isn't a surprise. But boy, that you can't kill this employment market, can you?
It doesn't seem to be killable. The other thing you did not mention was that people that have kept their job for more than a year are getting paid about 5.1% more than what they got paid last year.
Which is, once again, good news, but then you translate into the word labor costs and
inflation, wage inflation,
Yep.
That is going to drive that hamburger up at the fast food place substantially.
Oh, yeah. I mean, I had a little bit of fun making fun of it, not really in a serious fashion, but, California this week instituted their $20 minimum wage for fast food workers. And, yeah, everybody wants to make more money, but that translates into, like I said, a raise in pay translates into, on Wall Street, employment costs. And at this particular point in time, it's not exactly what the market wanted to hear, is it?
No, it's not. When you start to look at labor costs, you got to think, and I've not been to a fast food restaurant in a long time, but I got to think that. But I was talking to a friend. He said you can't hardly walk out of a fast food joint for less than $20 for lunch for one person. So, it's definitely costing more even in the low cost providers.
Yeah, fast food is no longer cheap food. Fast food is fast food, but like your friend says, $10 for lunch at a fast food joint. Well, okay, fine, you're getting quick service, but you're paying about the same thing you do for a sit-down place.
That's right. That seems to be the case. Like I said, I haven't personally experienced that, but that's what it seems to be right now.
It does seem to get that way. Other tidbits that are out this morning that just aren't necessarily getting to be good news. One of the biggest doves in the Federal Reserve is the president of the Cleveland Fed. Her name is Loretta Mester, and she was on the rubber chicken circuit yesterday, and she said that she still expects 3 rate cuts during this year, but instead of saying, I expect it, he's saying, but it's a very close call, which kind of is now one of the last holdouts saying absolutely we should, down to saying, boy, things keep going the way they are, I'm going to kind of change my mind. So just kind of makes the possibility of more rate cuts just a little bit more remote with every passing day.
It does. I consider, I keep looking at the numbers and just thinking, what are these people thinking? Because if the inflation continues and the economy continues to move forward the way it's going now, it just, as much as I would like to see a rate decrease, as anybody would, I think I read somebody's headline that a rate decrease would cause a stock market bubble.
Yeah, and there's some indication. One of the things that I had, I can't remember whether it was yesterday or the day before, one of the analysts was saying that the entire Standard & Poor's 500, based on price-earnings ratio, it's already in bubble territory. So we really don't need more unearned increases in price on stocks. We still have to let the profit margins catch up with the price of the stocks.
That we do, and who knows how long that's going to take.
Yeah, that's possible. And the thing is, the other side to that coin, though, is the longer we keep the interest rates up, which is probably necessary for the sake of the economy, the longer it's going to be before home sales, construction numbers, and everything get to be back into that predictable rise number. Because, well, like I said, the mortgage application index dropped another 0.6% this month, and it's already basically in the basement compared to 2 years ago. So, it's a balancing act here. I mean, yeah, we need to have a rate decrease in order to start the housing market back up in gangbuster level, but we don't need a bubble on any other element in the economy either.
Well, that's true, but let's face it, Dave. We're not really seeing a fall off in real estate. I mean, yeah, we're seeing a slowdown, and even here in Central Florida, we're seeing somewhat of a slowdown. Things are staying on the market longer, but we still don't have a supply issue, right? We don't have an oversupply, and the building is continuing. And I was reading a headline earlier today that gave an indication that at some point supply is going to be more than demand again. And it could be relatively shortly based on interest rates right now. And so when that happens, they expect to see some falling off of real estate prices as much as 20%. Now that's a pretty big decline right there, Dave.
And that is a challenge. I'm kind of in that same mode. Right now, we're looking at the possibility of supply outstripping demand by killing demand because of the mortgage rates. I'm saying I'd kind of like to jumpstart the housing industry and have a little bit more supply than demand by increasing the supply.
That's right. Yep. So we'll see what happens there.
Either way, houses are too dang expensive, and for those of us in the selling market, that's not bad news, but I feel sorry for people trying to buy in today's atmosphere. Other tidbits holding around right now: Humana and United Health Group. They probably were the biggest victims because the regulators, they have not increased payments for Medicare Advantage plans like they were expecting to. The big insurance companies figured they'd make more money next year by raising their prices to Medicare, and Medicare said pound sand, and evidently traders said pound sand to Humana and United Health Group, didn't they?
Well, they did, and here's the deal, Dave. I think the expectation I saw in a little article I read was like they were expecting payments to increase on their Advantage plans like 9.5%, and it's not like they're not getting an increase. But Medicare came back and said no, that number is going to be like 4.5 to 5.5% increase, about half of what there was expectation was, and so that's going to affect those companies' revenue for the next year, and so we saw a big hit yesterday because of that.
Boy, did we. I mean, United Health Group and Humana was down by 13%. United Health was down by 6% yesterday. And CVS, because they own one of the insurance companies and then they sell to their own insurance company, they were down by 7%. It was just kind of a crapola day in the healthcare industry. We're way too early to start earnings season. The in-earnest stuff is going to start next week sometime, but there's a few early reporters, and one we don't have around here, but I know we've heard of. Dave & Buster's had a number to report. How'd they do?
Dave and Buster's did report, but it was a weaker than expected fourth quarter for them, both on revenue and on earnings. However, they're still getting a bump in their stock today because they basically doubled the authorization to repurchase stock from 100 million to 200 million. So because of the stock repurchase thing, they're up 7.8% this morning.
You can't get the buyers to buy your stock, buy it
Just
yourself,
buy it yourself,
and that'll
right?
increase it.
Yeah. The
it.
other one I have, I did find one more, Dave. Cal-Maine
Yeah.
Foods, the big egg producer.
Yeah.
They also posted earnings. They made $3 a share on $703 million of eggs. That's a lot of eggs. And so they really had a pretty good third quarter. Going forward, they expect their sales to increase as well. They're trading at 4.9% this month.
Well, it'd be interesting to see what happens to them today because they announced at the end of the day yesterday that they're shutting down one of the big egg plants in Texas because of the bird flu pandemic out there.
Oh, really?
Yeah, you expect your omelet to cost more when you go in next week because there's going to be an egg shortage. Isn't that good news to know just in advance?
Absolutely.
News, news
Go buy
you
a couple
can
chickens.
use.
Go buy a couple
Absolutely.
chickens.
Yeah, but get them inoculated first. Crummy day on Wall Street yesterday. I'll let it sit at that. 45 minutes before we open this morning. What are we looking at so far today?
Dave, it's not looking much better. I mean, it's better than the close yesterday, but we still got the Dow down 0.1%. The S&P 500 is down almost 0.2%, and the NASDAQ 100 is down almost 0.4%. So some red ink across the board there. On the other side of the coin, the commodities, we've got a lot of green ink there. Silver up by 2.5%, gold up by 0.5%, then crude oil up 0.6, $85.72 a barrel. Now that's a little better than what it was when I first turned on my computer screen this morning. It was up over 86.
Jeez.
Yeah.
That's like a 5% increase over yesterday morning at this time. Crud.
Not pretty. Not pretty at all.
But glad I filled up yesterday. Overseas markets, the Asian Rim has finally taken the hint that we're doing something over here that ain't good for stock values, and they were pretty much down across the board. The Australian and the South Korean markets got hit worse, but the mainland Chinese markets were down as well. Better than 1% pretty much across the board on the Asian Rim. European markets are not quite as scared as Asia is. The German markets are actually up this morning. Most of the rest of the indexes are off to flat this morning, basically a little better than flat on balance across the European theater at the moment. If this stuff scares you on a day-by-day basis, it probably means you got too much risk in your retirement portfolio. If I'm one of those people, Phillip, how do I find you to get the risk out of my retirement?
Then give us a call at 863-382-0037 to walk through our core retirement analysis, where we'll analyze that risk for them and compare it to what they should have in their portfolio. And then join us this weekend for the Statler Financial Radio Show, 6 a.m. and noon on Saturday, 10 a.m. Sunday morning on Highlands News Talk 730 and 95.3 FM.
And tomorrow morning, hope for some good news here, same time together on Light. Phillip, thank you so much. I appreciate it, and I'll see you then.
All right, buddy. Have a great day.
Thank you. It's 105.7 Light FM and Statler Financial Services, Phillip Statler.
Hey, folks, again, I want to thank you for joining us today. Have a great day and join us again tomorrow. Take care now.